Ladies and gentlemen, my name is Normunds Čiževskis. I'm an entrepreneur. I own a small financial consulting company. Next spring we will celebrate its 15th anniversary. We help companies develop investment plans and business plans. We also help them attract funding from various sources of financing that were discussed today, including banks and risk investors. We also provide internal consultations to companies so that they can take high-quality decisions regarding investments and expansion of business. Other speakers today are mainly discussing various sources of financing, but I, in my presentation for those 2 hours, will focus on a different topic. That is, what you need to know before you go out and start negotiating with investors, what information you need, and what you have to do so that you can understand at first, is it actually worth starting a business at all. Here you can see a brief outline of my today's topics. I will talk about costs and types of costs in business. I will talk about such an important topic as the break-even point. I will talk about planning of money flows. I will also give an insight in fundamental principles of project analysis. Also, starting a new business can be regarded a project. I will touch upon alternative analysis and things to consider when taking decisions on what to do and what not to do in your business. Here you can see a bar chart with the main reasons of failure of failed startups. A survey was conducted a year or 2 years ago in USA. 100 or 200 startups were surveyed, and here you can see a summary of the main reasons of failure. Reason number 1 is no market need. This is a logical and obvious reason of failure. If nobody needs your product or service, nothing else matters. Reason number 2 is running out of money. Today, I will tell you more about planning of financial flows and money flows so that your company does not run out of money before it has become independent and profitable. As a financial expert, I'd say that reason number 2 is actually the main reason. As long as you have money, you can change something in your company. You can come up with new services or new products, you can change your team, find new customers, you can do anything as long as you have money. When you have run out of money, there's nothing else to do, then you simply need to go home. Have you seen this table? It is the so-called business model canvas. The idea behind it is quite simple. I regard it as a summary of a regular standard business plan. Of course, these 9 fields do not include all the details that you would normally include in a business plan, but this tool gives a very nice overview of things what you need to consider when planning and developing your business. Who will be your customers, who will be your suppliers, what you will do, what you will sell, how you will sell it, how you will attract customers, how you will deliver your services and goods. But we will mainly focus on the lowest 2 fields, costs and revenue. Costs can be divided into 2 large categories. First of them are investments. That is the money you need for implementing the project, that is, to start your business. Usually it is the money that is invested in capital assets such as facilities, buildings, vehicles, equipment, so to say, the money that you need to launch your business. The second category are all kinds of running costs or operational costs. For sake of our analysis, we will divide them into two groups, variable costs and fixed costs. Throughout my presentation, I will elaborate on all of these categories and groups. Where do costs and revenue come from? It's obvious that costs are caused by anything that happens within your company. All the fields marked in red are internal activities within your company. All of those activities incur some kinds of costs. All of the costs sum up in the lowest field where you can summarize, analyze and plan them, whereas revenue comes from only one source, your customers. Customers are beyond your company and beyond your control. As to the internal activities in the company, before the business model canvas became popular, the most topical model was value chain. I believe it is still topical nowadays. Michael Porter invented it. This tool gives a very good overview of all the activities, steps and stages that take place within your business. All of these steps, stages and activities, regardless of the models they are depicted in, all of them do create costs. Unfortunately, not all of those steps, stages and activities create added value from the point of view of a customer. We sometimes tend to believe that all of those steps, stages and activities are definitely necessary, and they will make our product or service more attractive to the customer. But it is not always true. Therefore, keep calm. I'm not going to elaborate on lean, agile or similar methodologies, but they do have one principle in common with my today's topic. That is, you need to eliminate unnecessary activities and unnecessary costs in your business as much as possible. What is the main objective and main precondition for success of any business? What do you think? Exactly. It is to maximize the profit. From financial point of view, the main objective is to maximize profit. It can be done by increasing revenue or reducing costs. Of course, companies can have also different kinds of functions, for instance, social functions that would be to improve the world, to eradicate poverty, eliminate inequality. It all can be done also by companies. But in order for a company to do so, the company needs to earn money at first. It needs to have enough money to cover its costs and also to be able to develop. Once a company has earned money and has maximized its profit, it can also engage in any kind of different activities. You can see a good example here. It is the profit share, shows profit shares of the global smartphone market as of 2015. The graph depicts EBIT, that is revenue before tax and interest payments. You can see several main players of the global smartphone market, but more than 90% of profit share goes to Apple. The runner-up is Samsung, and all the other market players take place 3. Their profit fluctuates around 0.0. In some years it's slightly above 0, in other years it's below 0. You can see that Apple is a champion in maximizing its profit. It's fantastic. You have to take into account that Apple has not sold the largest number of devices. All the Android producers definitely have sold more devices than Apple did, but still the largest profit share goes to Apple. Before I indulge in technical details, I'd like to share with you a couple of statements. One of the statements is true, and 2 of them are partially true, and I regard them quite dangerous. The true statement is, in order for your business to exist, there's only one condition to be met. costs should be smaller than revenue, or revenue should be bigger than costs. That's it. This is all what matters. As long as this is true, however you achieve it, everything is okay with your business. Now let us look at the partially true statements. Probably you have heard, you should not be afraid of large costs, but you should be afraid of small revenue. This is a typical slogan of marketing people and sales people. They have the sole objective of selling more, more and more. They claim that only cowards are afraid of large costs and real entrepreneurs are just focusing on maximizing their revenue. It is not wrong or false, therefore I said it's partially true, but in reality you should be afraid of both. Large costs and small revenue. Because it is not about absolute figures. It is about the relative ratio between costs and revenue. If you have large costs and large revenue, great. Brazilian national football team used to say, you can score as many goals as you want, we will still score you more. This is probably the principle behind this partially true statement. But in reality, you should always be afraid of both large costs and small revenue. The second partially true statement is in a way related to the previous. In order to earn a lot, you also need to spend a lot. This principle was very popular around 10 years ago when the bubble in the real estate market finally burst. People believed the more money you invest in real estate market, the more you will earn. People took that for granted. They thought that this idea has been mathematically and scientifically proven. But reality, unfortunately, was completely different, and many of the people who truly believed this idea, I believe, are still now hiding somewhere in Asia from their debts and creditors. In reality, there will always be costs. To any company, to any business, there will always be costs. The question is how large the costs will be and what kind of costs will there be. All of us know that as soon as you register your company, you start to have some costs. Tax payments, accountancy payments, money starts flowing away from your bank account. However, revenue is never warranted. You never know if you will have a revenue or not. Otherwise, it wouldn't be, as one of the previous speakers said, that only 8% of startups end up successfully from their experience. Well, in fact, I don't actually agree with this pessimistic interpretation of statistics. From point of view of risk investors and seed investors, a failed business is actually a regular business, but it is not growing exponentially. It's growing in small pace by 10, 15, 20% a year. But risk investors are interested in something like a boom-like growth. And if a business cannot achieve that, then this is considered to be a failed business for risk investors. The both partially true statements are based on this problem. We are the ones who control our costs. We control them internally in our company. It is not always easy to be done. Some costs are quite difficult to be controlled and reduced, whereas our revenue is always controlled by somebody else from the outside. For instance, when I finish with this lecture, I could decide to go to have dinner somewhere in the restaurant here in Talsi. I could go there, I could not go there, but the restaurant is opened and it has to pay for electricity, for other utility services, it has to pay salaries, but I, the customer, am the one to decide if I go there or not. The restaurant can do whatever it wants, it can have costs or anything, but I, the potential customer, am the one to take the decision if I go there or not. I am the one to control their revenue, but they can only be responsible for their costs. So let us move on to costs. What type of costs are there? First type of costs are investments. Investments are usually a large amount of money that is needed to start business. Usually this is large amount of money, but in service sector it's also possible to launch business with smaller investments, for instance, just to buying computer equipment and paying for internet connection. In a service sector, it's possible to start business also with smaller investments and become profitable, but as already said by representative from Pilem.fm, you also need to invest in service sector if you want to grow reasonably. But typically, you need investments in capital assets. These would be vehicles, office equipment, production equipment, office buildings, facilities, everything that is needed for your business to start functioning. The second type of costs are operational or running costs, everything that is needed for your business to function, operate and exist. They are subdivided into variable costs and fixed costs. If you want to do some more reading on this topic, then you will definitely be able to find much more information in English. There are not a lot of information in Latvian, therefore I have also written the terms in English on my slides. So let us start with variable costs. These are costs that do not vary just from season to season like heating costs, but variable costs are costs which are directly proportional to the production volume. If you produce something, you incur costs. If you don't produce anything, you don't have any variable costs. Typical examples are costs of raw materials, piecework payment to workers. In order to produce this particular table, we need raw materials and we need to pay for, let's say, an hour or half an hour for installing that. Then you can calculate quite precisely what the cost price per this table are. If we produce this table, we incur variable costs. If we don't produce the table, we don't have any variable costs. Usually they are depicted in as euros per piece, euros per hour, euros per kilowatt hours, etc. Typical example are electricity bills. The more electricity you spend, the more you pay. Here we can see variable costs depicted graphically. These are total variable costs. On vertical axis you see costs, and on horizontal axis number of units produced. If you don't produce anything, there are no variable costs. Variable costs are proportional to revenue. It is quite easy to control them. It is not that you can claim to your supplier of raw materials how much you are willing to pay, but you can decide whether to produce something or not. It depends on the demand. If there is demand, you produce something and you have costs. If you don't produce anything, when you don't have any demand, then you don't have any costs, and the revenue falls together with the costs. Fixed costs is a completely different story. Fixed costs do not change over a reasonable period of time, let's say over a year. On longer run, in absolute figures, all the costs are of course variable, they fluctuate, but the main idea is that fixed costs are not dependent on the production volume. If you don't produce anything, you will still have fixed costs. Examples are salaries to your employees unless you pay piecework payment, depreciation of capital assets, rental payments, and also costs incurred by so-called auxiliary activities. These are typically activities that are not part of your key production activities, but include such examples as administration, operations, or accountancy. These are integral parts of your unit, but not key stages of production. Units of measurement typically are euros per month, per year, per week, or euros per square meter. Here you can see fixed costs depicted graphically. Costs are depicted on vertical axis, number of units produced on horizontal axis. Within a particular range of production volume, the costs remain the same. Even if you don't do anything, if you don't sell anything, if you don't have any customers, you still incur fixed costs. Fixed costs are usually responsible for failure of many companies. The main challenge of new companies is to find customers. Fixed costs will not wait for you to find customers. As soon as you start your company, as soon as you hire employees, you start incurring fixed costs. And it's up to you how successful you are in finding your customers. It will determine the viability of your company. Fixed costs are not dependent on revenue, and this is the type of costs that is most difficult to be controlled or impacted. If we conclude rental agreements, usually we conclude them on longer run, and it's highly unlikely that we will manage to negotiate with landlords that we will pay less when we have hard times in business. Also, employment contracts are mainly concluded for a longer period of time. These are long-term costs. What else is important? That unlike variable costs that change proportionally to the production of volume, fixed costs, however, change in leaps. As you can see in this graph, you reach, here the maximum capacity of production is reached at 9 units. For instance, you need 5 employees to produce 9 units. If you want to produce 10 units, then you need to do something about it. Either you need to hire additional employees, or you need to invest in your equipment and its efficacy in order to expand your production volume. Therefore, the increase in costs will happen in a leap. Here you can see fixed costs per unit. Previously, I depicted the total fixed costs until reaching the maximum capacity. Here you can see the fixed price or fixed cost per unit. It also depicts that mass production is always cheaper than production on smaller scale. This could be one of the reasons why products from China or apples from Poland are cheaper than the ones produced locally, with other conditions being the same. The cost price per unit will be smaller if you produce more. It is also referred to as economies of scale. The more you produce, the lower the cost price per unit. Variable costs per unit remain more or less the same. If you produce 1 table or 10 tables, variable costs per unit will be more or less the same. If you produce 10 tables, probably we can negotiate better price with the supplier of raw materials, but it will still give just marginal improvement in costs. But fixed costs per unit become smaller the more you produce. It is especially critical at the beginning of business. If fixed price or fixed costs per unit are 30 euros a day, and you manage to sell just 1 unit, this 1 unit needs to cover all the fixed costs, all the 30 euros, let's say. If you manage to sell 2 units, then you need to, then you divide the costs per 2 units, etc. Therefore, it's very critical at the beginning of business. And it also explains why life is so difficult for domestic producers. It is impossible to produce something in huge amount for small price. Domestic producers can choose either to produce something for higher price and in lower volumes, or to produce something in lower volumes but for smaller price, but still they will be highly unlikely able to compete with mass producers. From unit 9 to 10 you can see a leap increase. This is a critical moment in business development and expansion, you need to consider alternative analysis outcomes and all the other tools in order to decide, is it actually worth expanding your business. At 9 units, cost price per unit is lower than €5, but if you produce 10 units, cost price is around €7–8. And you need to decide, is it actually worth investing so much in order to expand the production. You need to predict what could be the potential sales volume. If you manage to sell 20 units, the cost price per unit will be lower than it is for 9 units, but if you manage to sell only 11, 12 or 13 units, cost price will be higher than for 9 units, and this decision will actually do more harm to the business. Here you can see a summary. In red you can see fixed costs, in blue variable costs, and in black total costs. Even if you don't have any revenues, there will always be costs in your business, in any business. It's not like that if you have large costs you also have large revenue. No, not at all. You will always have costs, but revenue is never warranted. In order to help you wake up, let us have a small test. I will call you cost items and you will tell me, are these variable costs or fixed costs? Salary to workers. When it comes to salaries and wages, it depends on the company. So it could be fixed costs, variable costs, or combined. For instance, for salespeople, they usually receive some kind of fixed salary and an additional salary for which depends on the sales volume. If you have any questions, please ask them now. Don't wait till the end of my presentation. Feel free to interrupt me. Salary to administrative personnel. These are usually fixed costs. Usually administrative personnel is paid regular salary, not piece payment. Probably they can also have some annual bonus payment, but more or less these are fixed payments. What about utility bills? Well, it depends. Such utility bills as payments for water, heating, electricity for office buildings, these are fixed costs. It doesn't matter how much you produce and how much you sell. There will be fixed utility bills. But if water or electricity is used also in the production process, let's say for powering the equipment or generating steam, then utility bills could also be variable costs. Interest payments for long-term loans. These are fixed costs. All you can do is to negotiate with the bank to have better terms or smaller interest payments, but still these will be fixed costs. These costs will not depend on your production volume, but rather on the terms you manage to negotiate with the bank. Phone bills. Nowadays, I believe the most popular types of phone bills or phone connections are fixed tariffs. You can talk on phone as much as you want and you have to pay a fixed price. But some years ago, people usually had to pay more if they talked more on the phone, and it was quite critical, let's say, for a sales department. Costs of raw materials. Yes, this is a classical example of variable costs. raw materials are used for production. If you don't produce anything, you don't need any raw materials. External lighting for production plants, buildings. Well, it's not that you don't produce anything, you switch off all the lights on the street, do you? You still have some street lights on. These are fixed costs, I'd say. What about marketing costs? It can depend on each company and each situation, and also by what is meant by marketing costs. Marketing costs can also be a brochure or sticker which is added to every product you sell. Company Latvijas Piens currently has lottery. You can win a car, and the commercial of this lottery is attached as a sticker on each bottle of milk. The more bottles of milk they sell, the higher marketing costs they have. But still, marketing costs can also be included as a fixed item in your annual budget. So then these are fixed costs. Electricity costs for equipment. This is the same story as with raw materials and everything else that is directly used for production. These are variable costs. What about rental payments for premises? These are fixed costs. I guess it would be very difficult to find a landlord so understanding who would agree to take smaller rental payments if you have hard times in business. Have you managed to find one? Wow, great. Congratulations. So you have agreed with the landlords that you pay less if you have hard times in business or if you don't have high revenues. This is great. This is very important, in particular to seasonal businesses. It's very difficult for them to cope with fixed costs. And if you manage to negotiate with the landlords or somebody else on reducing your payments, that's great. What about insurance payments for equipment? These are fixed costs. Actually, these costs are determined by the insurance coverage, not on how much you use the equipment. The equipment is insured against theft or damage, and it does not matter how much you use them in production. This test was needed to train you to understand the criteria behind determining if the costs are fixed or variable. If the costs are directly linked to the production volume, then these are variable costs. If the costs cannot be directly linked to the production volumes, then these are fixed costs, even if they fluctuate seasonally. What matters is the linkage between the costs and production volume. Here you can see the summary of costs. You will have a presentation sent to your email. So in this table, here we have simply a summary. Now I would like to briefly touch upon the sales price. We, as financial analysts and internal financial consultants of companies, we calculate the cost price as a final outcome. Cost price is the minimum sales price necessary to at least cover the costs per product. The maximum sales price, however, is determined by the market and such external factors as your customers and competitors. It has very little to do with your costs. Basically, the financial analysis as whole simply shows you the minimum sales price necessary for long-term survival. The higher the sales price, the better in terms of maximizing the profit, but still the maximum limit of sales price is determined not by you, but the market. What makes up the sales price per unit? It is always made up by costs, fixed costs and variable costs divided by the number of units produced, there is a whole branch of financial science called management accountancy. It is engaged in finding the best way of dividing the fixed costs per processes, units, departments, etc. In green here you can see depicted the markup. All three of these components, markup, fixed and variable costs, create the total sales price. Fixed costs together with markup create the so-called coverage. Coverage is important to determine the break-even point. The size of the coverage determines the production volume necessary to cover your costs. For instance, if you sell tables, variable costs per table remain the same, regardless the sales volume. It is very difficult to change the variable costs per unit, whereas the fixed costs are directly dependent on the production volume. If fixed costs are 30 euros and you produce 1 unit, you need to cover this 30 euros by this 1 unit. If more, then it's easier to cover the fixed costs. And in green here, you could see depicted the markup. That is how much money you can afford to add to the costs. It is important to remember that cost price is always dependent on the production volume. It is directly linked to fixed costs. There is no thing like generic cost price. Cost price is always linked to particular production volume. Otherwise, it is impossible to calculate the cost price in mathematical terms. It means that before calculating the cost price, you need to predict the production volume and sales volume. Only then you can calculate the cost price. Of course, it is advisable to calculate cost price in different scenarios. What would be the cost price for sales volume of 5 tables, 10 tables or 15 tables? The difference will be huge. Basically, cost price consists of two elements. One of them is the cost and the other is the predicted sales and production volume. When you combine these two elements, then you can calculate the final cost price. If, for instance, you produce not only tables but also chairs, the fixed costs for your business has to be divided by the number of units of all types produced. For instance, if you planned to sell 100 tables and 400 chairs and calculated a particular cost price, but in the end actually you managed to sell 100 tables and 300 chairs, the cost price per table will also go up because the number of items sold is smaller than it was expected when the initial cost price was calculated. Usually during seminars I ask participants to take out their laptops and calculate everything in Excel tables, so then it's probably easier to understand it, but unfortunately it is not possible here. When we know the price, when we know the predicted sales volume, we can calculate, also knowing the costs, the minimum necessary production volume, or the so-called break-even point. That is a production volume at which the total costs equals the revenue. Here you can see it graphically depicted. In red you see fixed costs, in black total costs, and in green revenue. In the point where the line of total costs crosses the line of revenue, that is the break-even point, everything on the left is operating with losses and everything on the right is operating with profit. In this case, the break-even point is at 10 units. It is actually quite easy to be calculated if you have predicted your production and sales volume correctly and calculated your costs correctly. This also serves as a very good reality check. If you have calculated that you need to sell at least 10 units to cover your costs and reach the break-even point, you need to ask yourself, will I be able to sell actually these 10 units? Will there be demand enough in my target market? 10 units probably doesn't say much, but it can be such items as 10 houses or 10 yachts or 10 ships, something bigger. If you understand that you will not be able to sell more than 5 units in your market segment within, let's say, a month or a year, there must have been something wrong with your planning, and you need to go back to basics and decide what you have to change. You can change two things, either the sales price or production costs. If you have calculated everything correctly and you cannot change neither the sales price nor the production costs, and you cannot reach the 10 units as sales volume, then most likely you need to give up on this idea. This is the first reality check you need to do. People often say that the whole world is now like a market, as a market is limitless, or it seems to be limitless. In many cases it is so, especially when it comes to IT services. It is difficult to predict at the beginning if the number of users of your service or product will be 10, 10,000 or 1 million. But many market segments, for instance, local markets or niche markets, are quite limited. For instance, if you have planned to focus your business on Talsi inhabitants aged between 18 to 25 years, and you need 15,000 as your potential customer basis. Nevertheless, you understand that the number of inhabitants in Talsi in this age group even is not so big. It means that there must be some problem with your planning. How to reduce the break-even point? You can only do that through reducing costs. You cannot increase the sales price. The price is determined by market. Sometimes it might be tempting to increase the sales price, but you definitely need to take into account the purchasing power and expectations of your customers, as well as prices offered by competitors. This is what actually determines your price. Well, you can try to do the way Apple did, and you can simply set your price regardless the prices of competitors. But then you need to invest heavily in marketing. You need to position yourself claiming that you don't care about prices of competitors, but it is very difficult to do it and very expensive. The first and the most decisive objective and task of a new company and business is to survive until reaching the break-even point. Do you remember the slide with reasons of failure of startups? One of the reasons was running out of money. It means that these companies ran out of money before having been able to cover their own costs. All of these companies went bankrupt because they didn't manage to survive until reaching the break-even point. Before having reached the break-even point, operations are like pushing the car with your own hands. When you reach the break-even point, finally, it is as if fuel had been magically appeared in your car and your car starts running on its own. Your business automatically generates the resources it needs to cover its costs and to cater for its development and growth. If someone tells you I went bankrupt because I ran out of money, it simply means that their break-even point was too far in the future and they didn't manage to survive until it as a business. Let me be open with you. I believe that risk investors and similar investors, by expecting the boom-like growth from startups, very often they force the authors of business ideas to set too ambitious and unrealistic aims. If this small company had had an opportunity to grow organically and naturally on its own pace, to grow its customer base throughout 2 years and increase its costs as needed, then many of the failed startups would have survived. But since these startups had set a goal to earn millions as soon as possible, then all of their costs were most likely adjusted to this one single goal. They were thinking, okay, I need to earn million, I need then 10,000 customers, it means 100 salespeople, I need marketing department, service department. It all generates costs. And all of these costs are simply based on the expectation of earning a million at some point in the future. But do these companies really need such a huge personnel? Often they don't, in fact. But the costs for the employment, salaries for premises and equipment, they start accumulating from the first day on. They will not wait for you to build your customer base and become profitable. So reaching the point of break-even is task number one of any new company. When you have reached the break-even point, your life becomes much easier and nicer as a company. There's much lower level of stress. Unless you're completely dependent on your investors, you can then grow at your own pace, slowly, gradually, carefully, and take as little risk as possible. If you have managed to reach the break-even point, it means that your business idea is potential, validated, proven, and profitable enough to be viable. But now let us talk about tools for financial planning. I'm going to talk about money flow. Money flow shouldn't be mixed up with a profit and loss account. As you know, every company has 3 types of financial statements: balance sheet, profit and loss account, and money flow. Money flow is not mandatory. Sometimes also indirect method is used for calculating money flows, which is not effective enough. I will tell you about the differences between profit and loss account and money flow and why money flow is more important. There's a quote from a financial book I like a lot. It is written in simple language. The target audience are owners and managers of small companies. This book explains in popular terms all the financial issues they should know. There's a quote: you can operate a long time without profit, but you can't survive one day without cash in your bank account. The profit and loss account simply shows you the historic date of existence or non-existence of profit. Even without performing the profit and loss account, you know about the existence or non-existence of your profit. Whereas money flow shows the availability of money in your bank account and also shows what will happen with your bank account and the money in it after half a year, how much money you will have there or how much money you will need. The profit and loss account is usually performed 1, 2, or 4 times a year, and it shows revenue or turnover, costs, including depreciation of capital assets. Here we can see the first big difference compared to the money flow. As you know, depreciation of capital assets is simply a term in accountancy. You will never see something like that in your bank account. the money was invested in capital assets already at some point in the past when you bought the capital asset, but in the profit and loss account, this money is simply divided on year-on-year basis. And in order to calculate the profit, the costs are subtracted from revenue in the profit and loss account. What is important is that in the profit and loss account, your situation in the bank account is not considered. All the entries are entered according to the date of the recording. As soon as you issue an invoice, you write it in the profit and loss account, even if your customers will pay for the invoice within months, 2 months, or they will not pay at all. So for profit and loss account doesn't reflect the situation of your bank account, but simply the dates of entry of accountancy records. Money flow, however, is a completely different story. It reflects your financial sustainability. Do you have enough money? If not, how much money you have, how much money you will need in the future, and when you will run out of money. Money flow allows planning the activities, supply chain and value chain of your company in realistic terms. It allows planning you when you receive a product, when you sell it to your customer, when you get money for that, etc. Besides, all the financial analysis of projects are based on money flows, including capital return and financial return. Money flow also allows you comparing different alternatives. According to global practice, money flow consists of 3 components: operating money flow, investment money flow, and financial money flow. The main component is operating income money flow. It is of interest both to you and also to the investors. It shows whether the company can ensure its viability through its operating income. If not, then additional information is provided by the investment money flow. It mainly reflects the purchase and sales of capital assets, and financial money flow, which mainly shows external sources of financing, such as investments and loans and repayments thereof. So once again, if the operating income money flow cannot ensure viability of the company, or we want the company to grow and we invest in the company, then all the incoming credits and investments and repayments will be reflected by investment and financial money flow. I will show you a practical example to illustrate the differences between profit and loss account and money flow. This is a profit and loss account for one transaction. Let's say you buy an equipment for 6,000 euros, you sell it for 10,000 euros, and your profit is 4,000. This is how it's reflected in the profit and loss account. Let us assume that you don't have to pay company income tax, you are a micro company, and from the next year on nobody will pay taxes based on the profit, but rather on the dividends. So here you can see a simple mathematical analysis. If you buy something for 6,000 and you sell it for 10,000 and you earn 4,000 as a profit, it sounds like a good deal. However, if you transfer this to money flow, there's a new dimension, time. Money flow always has 2 axes, time and the amount of money. In order to perform the money flow analysis, you need not only to know the costs and revenue, but also the terms of payment and delivery. The terms are as follows. You need to pay all the amount in advance to the supplier. When the supplier has received all of the amount, then within 1 month it delivers you the equipment. Then you sell the equipment to the customer, and the customer pays you within 20 days after issuing the invoice. Here you can see the same transaction in terms of money flow. This is more complex but also much more informative. Here you can see that in the first months, in order to launch the deal at all, you need 6,000 euros to buy the equipment. Then you wait for 1 month until the equipment is delivered to you. You don't have any revenue. Let us assume that you don't have any additional costs, and only in the third month you receive 10,000 from your customer. In the third month you also receive the 4,000 euros as profit. But when you know the terms of deliveries and by using the money flow method, you see how much money you need in each month to launch and to continue the transaction. This allows you performing and planning your operations. You can think, okay, I need 6,000 as a loan, but this loan is given only for 2 months, not for 3 months. Probably I should negotiate with the suppliers that I could pay only 50% in advance before receiving the equipment and the rest after receiving the equipment, or I could probably request 50% of advance payment from my customer. The profit and loss account does not give you this information, and it does not allow you to plan your operations in realistic terms. By planning the money flows, you plan your business. It is not about some abstract figures in Excel tables. You can write something in Excel table, but there's no interest in cheating yourself. You are calculating and analyzing the money flow for your own needs. And you are planning your own business. Money flow makes you think of what is happening in your business, when it's happening, and what the costs are. But now let us talk about financial analysis of projects. What is a project? Project is basically any important activity in a business with particular aim, specific costs and benefits, and specific term. So basically it's something that you have defined more or less clearly. You know how much it will cost, how much you want to earn from that, and also you know what the time period for it is. This is project from financial analytics point of view. The main aims of financial analysis are to determine the financial return rate of the project. In other words, in order to determine if the project will give you any revenue and profit. Financial return rate can be calculated in terms of investment return. It helps you determine whether the project will cover all the investments and also all the variable costs and long-term costs. If the answer is yes, the costs will be covered, then it's worth implementing the project. If not, probably it's worth rather giving up on the project. The second indicator is own capital return. In order to calculate that, you need first of all to know what sources of financing you will use for the project. This is an important indicator for you and other investors. It shows not the total return of the project, but the return of the money you have invested from your own means. Financial analysis also shows the financial sustainability of the project, and it helps to plan the money flow so that you don't run out of money. You have to perform the financial analysis for the whole life cycle of the project, not just for 1 year or 2 years, but for the whole life cycle of the capital assets linked to the project. If it's real estate project, then the financial analysis has to be performed for, let's say, 15, 20, 25 years, for a longer period. If it is about equipment, then financial analysis has to be performed for 5 or 7 years, depending on the service life of equipment. If you buy equipment that will be functional 5 or 7 years, and then you have to sell it or write it off, and your financial analysis shows that this equipment will not have sufficient return within 5 or 7 years, it's not worth buying this equipment. If you perform financial analysis for 2 years, but your equipment has service life of 7 years, then you don't know what will happen next. If you go to bank and you want to take a bank loan, you will be requested to submit a financial plan or financial project for the whole period of the loan. If your equipment has service life of 7 years, bank will not provide you a loan for 15 years. Another basic principle behind financial analysis is the so-called discounted money flow. I will elaborate on that later on, but the idea is that the money flows are considered for the year when they are actually generated, and then these money flows are discounted to the first year of the analysis, that is, to the current time. It is not useful to calculate financial analysis for too long period. First of all, because it is very difficult to calculate or to predict the very far future, let's say 50 years, because most likely the business idea will not be topical anymore at that time. And you need to take into account that the value of the money keeps decreasing year by year. The further in the future, the lower the value of the money compared to its value nowadays. I see that some of you don't seem quite comfortable regarding the discount rate. I will later elaborate on that, and you will also be able to ask questions. Financial analysis and money flows include the main cost and revenue items. The main items, by that I mean items of some considerable amount. You shouldn't include hundreds and thousands of cost items in your financial analysis, otherwise it will be very difficult to comprehend it. What is important is that in a financial flow or money flow, you do not include depreciation of capital assets, unlike it is the case with profit and loss account. In financial analysis, always at least two alternatives are analyzed: without the project and with a project. Without a project, it means the current situation. We always have the choice either to perform a specific activity or not. If we want to do something, we compare the current situation with the predicted situation after having implemented the respective project or activity. Often there are more alternatives. For instance, if we need a warehouse, then we have several options. Either we build a warehouse by ourselves or we rent it. Then we can compare the financial analytics and financial costs of the both alternatives, how much the building of warehouse would cost and how much the rental payments would cost. These alternatives are compared to each other and also to situation of no project or not doing anything. If our business idea is bad and would rather create losses, then it's better and cheaper not to perform this business idea or project. In fact, it happens quite often. Psychologically, we believe that if we start analyzing something and if we start considering a business plan, then we definitely need to arrive at a positive result. especially if we are the authors of the business plan or business idea. But the problem is that most of the business ideas are not viable. Even those that have managed to receive financing, and even those whom many of investors and banks have believed. I'm not even talking about the ideas that have just come into our mind and we are checking in Excel table, what about this idea? Will it be sustainable and viable? In order to analyze different alternatives, we use the so-called incremental costs and benefits method, or additional costs and benefits method. Let's say we want to expand our production volume, and we look at the costs this proposal or idea would generate. One of the cost items is street lighting. If we build an area of additionally 50 square meters, we see that no changes will affect the cost item of street lighting. If this particular cost item is not impacted by your decisions and you do not regard it as part of the incremental cost and benefit analysis, you only regard the costs or the cost items that are impacted by the decision. When it is about starting a new company, there are no revenue, only costs. Therefore, all the costs of a new business are the incremental or additional costs. But it is more difficult when you have an existing company and you need to decide which cost items will be impacted by your decision of implementing a project. Probably you can take simply the whole list of your cost items and think and check which cost items will be impacted by the project and which will not be impacted. And you only analyze the cost items that will be impacted by the project. Here you can see the formula for discounted cash flow. With PV, you see the present value, FV is the future value of the respective year is divided by 1 plus the discount rate multiplied by the year of the discounted period. So, as you can see, the further in the future, the lower the value of the money. I simply showed you this formula for the sake of interest, but you can also calculate it quite easy with an embedded formula in Excel table. But the idea behind the discount rate is quite simple. Money in the future will be less valuable than it is now. We have the gut feeling that money tends to lose value over the time, but we believe that it's related to inflation often. But this is not the idea behind the discount rate. According to the principle of discount rate, money today is more valuable because today you can invest it and gain profit from this money. Even if the inflation rate is 0, money loses its value over the time if you do not invest the money. You lose the money in terms of ungained profit. The idea behind discount rate is lost return or lost return from capital investment or ungained profit from one project, or the so-called opportunity costs. And now we are going to talk about analysis of alternatives. Do you remember the graph where there was a big leap in fixed costs between 9 and 10 production items, and I said this is a critical moment for the management of the company and they need to decide is it actually worth expanding the production volume. In order to take any decision in business, you need to compare different alternatives from various points of view or from various aspects. Only the last aspect is financial aspect. First of all, you need to assess the economic benefit of alternative. Will there be enough demand for the production volume? For instance, if you want to focus your business on young people in Talsi, first of all, you need to understand how many of young people in the respective age group are there in Talsi. And you need to remember and you need to understand what happens with demand and what will happen with the demand in the future. If you see that there's insufficient demand currently and it also shows downward trend in the future, probably your idea should be given up or it should be amended. Yes, exactly. You should probably change something in your initial business idea. Probably your target audience could be young people, not only in Talsi, but also in Kurzeme region as whole or Latvia, or it could be young people not aged between 18 and 25, but 18 and 35. In other words, you need to understand what is happening with the market segment of your interest. If you see that there is no demand or the demand is showing downward trend, you need to change something in your business plan. Exactly, it is about marketing. Yes, exactly. Well, first of all, you need to decide if this idea is good enough. If you understand that you need to increase or expand the scope of your operation and you need to cover not only the market in Talsi but also in Bauska or other city, but it all generates additional costs, for instance, marketing costs, transportation costs. Many cost items are impacted by one decision or the other. Of course, there are businesses that are targeted at end customers and there are business-to-business operation model, but all of them, directly or indirectly, are definitely dependent on this number of inhabitants and demographic trends in the country, including increase or decrease in the number of inhabitants. But let us assume that we know that there will be demand, then we need to assess other aspects, technological aspect, social and legal aspect, also probably environmental aspect when it comes to bigger projects, and only in the end we analyze the project or alternative from the financial point of view. Why is financial evaluation the last one to be performed? Because all of the ideas can undergo financial assessment at any point in time. Even the most unrealistic and stupid ideas. Therefore, financial analysis should be performed as the last one when you have verified that the project satisfies all the other criteria and aspects. You also need to consider alternative or opportunity costs. Let's say you have limited resources, only 10,000 euros, and you have choice either to invest the whole amount in project A or project B. You cannot invest in both of them. Then, in order to take the decision, you need to know several things. You need to know how much you will earn from investing in project A and also how much you will lose from not investing in project B. These are the so-called alternative opportunity costs. They are not shown in accountancy entries and records. You can only see the profit you have made, but not the profit you have not made. Whereas analysts and financists always need to consider that any questions based on limited resources always create alternative or opportunity costs in terms of ungained profit. As to additional or incremental costs, you can divide them into two categories: avoidable and unavoidable costs. The relevant or unavoidable costs are future costs that will be impacted by your decision. These costs will be directly affected by your decision. If you decide to do something, you will incur these costs. If not, you will not have any costs. If you implement the project, you will have costs of 10,000 euros. If not, you won't have these costs. And then there are the irrelevant or unavoidable costs, which are independent of your decision. For instance, as in the example with street lighting, there will be costs, but your decision will not impact these costs at all. Therefore, you don't consider these costs in your analysis in different dimensions. A specific and quite common type of unavoidable costs are past costs, or the so-called sunk costs. These are costs incurred in the past that can not be changed or impacted by your current decisions or decisions taken in the future. You have already spent the money. Whatever you do, the money is already spent. From the point of view of financial analysis, this is one of the most common mistakes by managers. They tend to take future decisions based on their past activities. This is related to the psychology of people. People think, we have invested so much time and money and resources and labor force in the project. How can we simply say that this project was a failure and the project was actually a mistake? I will look like a fool if I admit that the decision I took in the past was wrong. Therefore, people tend to take bad, disadvantageous decisions also in the future just based on the past investments they have made. There's just one exemption. It is if one of the project alternatives allows you recover the past costs or sunk costs in one way or another. For instance, you have bought an equipment. If you implement project A, you will not use this equipment. And you can then probably sell or rent this equipment to somebody else. But only if you implement project A, and then these past costs, or the so-called sunk costs, will have something to do with your current decision. Okay, I'll show you an example. Customer wants you to produce product B. In order to produce this product or manufacture this product, you need equipment X. You bought it 3 years ago for 50,000 euros. It already works with its full capacity in manufacturing product A. The only way to start manufacturing product B is to reduce the production volume of product A. It will cause ungained profit in amount of 2,000 euro. besides manufacturing of product B, will also generate additional variable costs in amount of 5,000 euros. In this example, you see three types of costs. 2,000 euros are the so-called alternative or opportunity costs caused by ungained profit. You don't see ungained profit in financial or accountancy statements. If you continue manufacturing product A, you have profit of 2 euros and you see that in your accountancy statements. If you don't produce it, you don't see that in your accountancy statements and records. But when taking decision, you need to consider this factor. 5,000 euros are additional or incremental costs caused directly by your decision to start manufacturing product B. If customer says, I will pay you 6,000 euros for product B, then you calculate your costs and say, no, it will not be enough, it will not cover my costs. 5 costs are additional or opportunity costs, but 6,000 will not cover altogether the opportunity costs and incremental costs or alternative costs caused by ungained profit. The third type of costs in this example are 50,000 euros, which are the sunk costs. These costs do not have any impact on the decision, or the decision doesn't have any impact on these costs. You spent those 50,000 euros 3 years ago when you bought equipment X. But probably the decision maker is all the time thinking about those 50,000 euros and believes that this equipment should be used as much as possible in order for it to be cost-effective. But from a mathematical point of view, it has nothing to do with your financial analysis of the alternatives. What is the structure of financial analysis? First of all, you need to determine investment costs, how much the project will cost in terms of capital asset, equipment, labor force, etc. Secondly, you need to determine the operational costs and revenue for the whole life cycle of capital assets linked to the project. When you know those two factors, you can calculate the return of investment. That is, will the revenue be enough to cover the operational costs and investment costs? If the answer is yes, then you need to think about the sources of financing for this project. You need to consider how much money you have, how much money you can borrow from your friends or family, and how much money you need to attract from investors and risk investors, if any. As many of the speakers today already said, for startups and new companies, it's very difficult or almost impossible to get bank loan. They need at least 2 years of proven positive money flow in order to get bank loan. The title of this seminar was Alternative Sources of Financing, but actually these are the only sources of financing for new companies like Risk Investments and Altum. The so-called typical bank loans is not an option for new companies and startups. When you know where you will get your financing and also the terms of the financing, you can calculate financial sustainability in step 5. First of all, you can calculate if the financial sources will be sufficient to cover your costs in the future until reaching the break-even point. And then you can also calculate the capital return of each investor. That is, not the capital return of the project as whole, but the profit to you personally. Investment return is calculated by the investment costs and by revenue, Revenue includes operational income and the remaining value of capital assets. This is not remaining value in terms of balance sheet or accountancy statements, but in terms of usefulness of the capital assets. For instance, you want to build a manufacturing plant and buy equipment. Manufacturing plant will have a service life of 20 years and equipment will have service life of 7 years, and you perform financial analysis for 10 years. You want to have a loan for 10-year period. You see that the manufacturing plant, the building, will be functional and will bring you benefit also after the end of the financial term, after those 10 years. So you can calculate that in terms of future income or future revenue. This indicator or figure should be added to the last year of the period of financial analysis. Sometimes people tend to forget about it, but according to the best practice, you also should include the future value in the financial analysis. Also, when calculating the value of a company before acquiring it, future value of assets is also included in the financial analysis. You perform money flow analysis for, let's say, 5, 10 or 15 years, not for 50 years in the future, because it's too difficult to predict so far in the future, but still you also include the future value in your analysis. When you receive the presentation, you can have a more detailed look at the typical positions of the investment return money flow. These are the typical positions or items included in the calculation. If you type in the correct formula, you can calculate the net value of all the current assets and also of the future value of the assets. If you perform the respective project for over a period of 10 years, you see that investment return will be 20% a year. A question is asked by the audience, but the interpreter couldn't hear it without microphone. Yes, of course, but it is not nonsense or useless at the moment when you perform the calculation. Of course, it has to be based on specific assumptions and specific circumstances and related to a particular number of customers, number of employees, sales prices, etc. It serves as basis for analyzing the money flow. And you always know, or you should know, the main assumptions for the immediate future. It is more than clear that circumstances will change. This is not a dogma. This is just a tool for decision-making based on your best current knowledge. If things change, you can easily do some adjustments in Excel table. It is just a plan. If these figures, let's say, as it says here, revenue 1 million euros per year, if these figures are based on justified number of customers, justified sales price and sales volume, then you know that this figure is not just made up, but it is based on specific indicators and your specific expectations and predictions regarding the market size and sales volume. Of course, and banks always would request you to submit the best case and worst case scenario. However, if you analyze alternatives or options just for your own needs, then I would advise starting with the most plausible one. Then you can later on start playing around with alternative analysis or checking of different assumptions. What happens if the number of my customers fall from 10,000 to 7,000? How will that impact my viability? How much money I could take as a loan? Should I build or purchase the premises my own, or should I rent them? You can play around with different decisions and analyze them. And this analysis is very useful for all the decisions that have some costs as a consequence. I can tell you more than clearly that not all of these figures will not be 100% the same as in your money flow plan, but you need to plan your future in business. Especially if you want to receive money from investors. You cannot simply go out to investors and say, hey, I want 100,000 euros, I don't want to calculate anything, let us live and see what the future brings. No, nobody will give you money just like that. This is also a very good tool for checking yourself. I have heard people saying, I don't know how much it will cost for my business. You should know. If you want to have business and if you want it to be viable and successful, you need to know the cost items and their impact on the future of your business. You need to plan carefully. Risk investors pay close attention to that when analyzing business plans. They are not as much interested in the figures than they are interested in the knowledge and considerations by the author of the business idea. They want proof that the author of the business idea has paid a lot of effort in creating the business plan, even if investors later on would completely change the business plan or investment plan. They still want to see the justification, and they still want to have the proof that the author of the business plan is knowledgeable and is aware of the business and the market. Here is just a summary of the incoming and outgoing money flows when calculating the capital return. When calculating the investment return, we did not look at the potential sources of financing, but now we know at this point that the project will be in part financed by a loan, and therefore in the outgoing money flows we have also included loan repayments and interest rates. When calculating return, often you can see these two abbreviations, IRR and NPV. IRR is return in figures, whereas NPV is net percent value. When you want to compare two projects or two alternatives, you need actually to consider both of those indicators. IRR simply shows you the amount of the return in percent. It shows, is it worth investing actually in a project, is it worth starting a project, and NPV shows the return in absolute figures. If you have two options of projects and they have the same cost items, and you see that one of the projects has IRR or return of 20%, other of 30%, of course take the one with 30%. However, if projects have different costs involved, then You need to consider both IRR and NPV, because sometimes these both indicators send contradictory signals. Sometimes the percentages can be different to the actual return in value or in money. Here you can see a practical example, Project A and Project B. Investments in Project A, 200 euros, in Project B, 1,000, revenue 380 and 1,400 accordingly, net revenue 180 and 400, NPV 180 and 400, whereas IRR is 90% for Project A and 40% for Project B. In Project B, you invested 1,000 and you received 400 euros. Whereas in Project B, you invested 200 and you received 180. When comparing IRR, of course, Project A seems to be more profitable, whereas in absolute terms or in value, because you want to earn money, not percent. Project A is less advantageous, it gives just 180 euros. However, if you have, let's say, 1,000 euros and you can repeat Project A 5 times, then you will earn much more because the IRR is 90%. But still, if you have just one shot, then you should go for Project B. This is a practical example why you should consider both IRR and NPV. Now, let us talk about sustainability. According to the official definition, project is financially sustainable if its cumulative value balance throughout all the period is positive. In real terms, it means that you have money in your bank account. And even if at one point you run out of money, you know where to get additional financing. For instance, you can get financing from a credit line or loan from a bank, the so-called overdraft. Something like that could be handy in case when you run out of money temporarily. You remember the example of buying equipment for 6,000 and selling for 10,000. In this case, also a credit line or overdraft would be handy, so that you have those 6,000 euros to pay in advance to the supplier, and then you can wait 3 months until your customer gives money back to you. When calculating the financial sustainability, you need to analyze all the possible costs and revenue of a project. The main aim is to make sure if the incomes or financing and revenues from all the possible sources will be sufficient to cover all of your costs on longer run. This is the most detailed type of money flow analysis. Investment return is usually analyzed on year-to-year basis, whereas sustainability is analyzed month by month. Analysis of financial sustainability involves a very detailed planning of money flows, and it helps you to determine what happens month by month with your business, will you have enough money, and what you will do when you run out of money. When it comes to means of financing, if at some point of time the account balance is less than 0, or around zero, then you need to ensure additional financing. First of all, you should remember that financing is never free of charge. Either it comes from your own funds, it means that the money is frozen then in this particular project and you cannot use it for any other sources or projects. If you have a lot of money, if you have, let's say, several millions and you only need to invest 5,000 in a project, then it is almost like free of charge. But still, you could take those 5,000 euros to bank, invest them or deposit them, and then simply receive higher return on the interest rates. The second source of income could be banks or credit institutions. They have quite low risk appetite. Percentage rate or interest rate is quite also relatively low. And banks and other credit institutions are just interested in the repayment of the loan. And the third source of financing are investors. They are on the same boat with you. They care for you. They take the risk instead of you, but they also expect to have higher interest rate. And the aim of investors is to grow the value of your company. Why? Because if the value of the company grows, also their capital share and its value is growing. Investors want to see maximum growth of your capital shares so that they can sell the shares very successfully after 5 or 7 years. The golden principle of financing is that long-term investments should be financed with long-term loans and short-term investments with short-term loans. You don't take a 10-year loan in order to buy raw materials you need for the next month. Or even worse, you should not take short-term loan, which usually involves much higher interest rate for financing long-term projects. This is otherwise a very direct way to going bankrupt. Short-term loans almost always have higher interest rates. Long-term loans are expected to be profitable only in the future. So it gives you time to think of how to repay the money. However, 10 years ago, when there was bubble in the real estate market, people took short-term loans, bought flats, and then sold the flats a couple of weeks later because the price was going up and up and up. This was quite advantageous for some time and quite profitable, but then finally this scheme had to stop. The bubble burst and many people had problems with repayment of the short-term loans they took. Here you can see an example with investments, operational costs, operational income, and financing needed. So you know that here in the on the fourth period, you will need 100 euros, let's say. This is like planning of money flows. A summary. Normally, each of the cost items would have also additional sub-items under them. But in summary, it looks like this. Costs, revenue, and net money flow, and also cumulative money flow, which shows the balance. And this balance is taken over from one period to the next. So we are back at the same table of business model canvas. What time is it? I'm about to end my presentation. How long I've been speaking? Oh my, 2 hours. What I want you to take home with you is that money flow is not just taken out of blue. It is not something with imagined figures and tables. Money flow makes you think about your business and your operations. You can only hope that you will have revenue, but it will be determined by your customers and other external factors. But you can think about your costs, you can calculate them quite precisely, and you can plan them for the future. Therefore, I don't see any reason for not performing money flow analysis. If you don't know your money flows and you don't know anything about your business, probably you always don't have to indulge in such details, how much you paid, let's say, for utility bills half a year ago, but you need to be aware of the main cost items of your business. And also you should be aware of the time it takes from, let's say, sending out an invoice and receiving the payment for the invoice. Of course, it depends on many factors, delivery dates and terms, and liquidity rates and everything. There are many ways of optimizing businesses, especially existing businesses. But for new businesses, money flow is a very good training for your thinking. You can start by jotting down the main assumptions and thinking and reflecting of different scenarios. What would happen with your business if you do this or that? You should have a business vision, you should have an aim, you should understand what you want to do and why you want to do that. But everything should be based on the idea. However, when you put your idea on the paper and you start to analyze it in figures and write them in an Excel table, then it will lead to particular objectives and will tell you how much you could earn by your idea, and this transforms your idea or fantasy into a particular specific plan. That's it from my side. Do you have any questions? It's inevitable. It requires specific knowledge. I have done this for 15 years, therefore probably it's easy for me to say, yes, you need to perform money flow analysis. But I know personally when I give training to new entrepreneurs and I give training to students in an academy, many people tell me, I don't even know how to work with Microsoft Excel, and you start telling me something about money flows and discount rates. No, it's too much. There's not very much more than this involved. I know that most of entrepreneurs don't consider discount rate when they calculate the profit or return. They don't consider the discount rate, and they believe that the 10,000 they have now will be worth the same after 10 years. But in order to do everything what I showed you here, you need more specific knowledge, and you need to pay attention to different factors and aspects. The basic principles are the same. You need to understand, is it worth investing in a specific project or not, and what will the return be. The larger the project, the more detailed the analysis, of course. Nobody is performing a very detailed 10-year analysis for small projects with investment amount of, let's say, 500 euros. Many things can also be predicted. Therefore, all the financial analysis should be followed by risk analysis. Financial analysis includes different assumptions of yours. Let's say you will have 5 big transactions a year, but then you need to perform risk analysis for what happens if something goes wrong. Then you need also to invent plan B. If you start to think about planning B at the moment when you feel that things are going wrong, it is, well, it's still okay. But people often tend to go and push through with plan A till the very end, when the insolvency administrators are already at their door. We never develop 5 plans in the same level of detail. Usually we consider one plan as the main plan, and this plan is also later on subjected to the risk analysis and everything. The question was asked by the audience, interpreter could not hear it. I know that sometimes the expected revenue and income, I have seen that it later on in real life actually was different by 1/3. As you said, these plans cannot predict the future precisely. Of course they cannot. Things will change in life, definitely. But money flows and risk analysis is your opportunity to consider the options, what could happen in the future. And simply, you can also come up with plans, plan B or plan C for one of the alternatives or options you have chosen. While you risk your own money, go on. Many people do like that, but as soon as you start using money of other people, then it's not a good idea. Then you shouldn't be so careless with plans and projects, because other people tend to care for their money and they always ask, have you considered this or that? And they ask you to give more justification on investments. It highly depends on the business sector. I've heard that some companies invest around 10% of their turnover in marketing, but there are different kinds of businesses, for instance, internet-based businesses that sell their services with click-through advertisements. This is also marketing business, but in that case, one click would be one sold unit. It's very difficult then to predict the sales volume beforehand. For many people, marketing and sales is one and the same, but you should think about that more carefully. People tend to create money flow analysis with marketing and sales costs all together, but they don't think of attracting new customers. If you want, for instance, not only to enter the Talsi market, but also Bauska market, and you have money allocated for commercials in local newspaper, or advertisements in Facebook, these are the costs that are directly related to your decision to enter the market. And people often are quite good with calculating some costs, and planning particular revenue, but you also need to know what is the justification for your revenue, where the revenue will come from. And generating revenue also is almost always related to some kind of costs, for instance, for marketing. But yes, I have heard that some companies invest around 10% of their money in marketing.